Banks are legal wallet burglars. They use credit cards to offer you digits, then you pay them 20% of the digits in real cash. Have you ever glanced at your savings account, only to realize the interest they pay on your savings is barely 1/10 of the 20% they collect when they offer you digits in plastics? Many ponder if a credit card with $30,000 digit is actually backed by a $30,000 stack of cash at the bank. Yet, at the same time, we're bombarded with offers for credit cards promising rewards and convenience, all at a hefty interest rate that can quickly spiral into a mountain of debt. This, my friends, has always been a head-spinning banking paradox, a system seemingly designed to reward those who spend and penalize those who save. Stop rubbing your customers' bank stars. Get ready to have your perceptions challenged as we lift the veil on the banking industry, revealing the secrets they don't want you to know. We'll dissect the mechanics of credit card interest, exposing how banks profit from your spending habits. Prepare to be astonished as we unveil the staggering sums banks amass, while your savings account struggles with rising costs. Understand the rules of the game and play it to your advantage. We'll equip you with the knowledge and tools to make informed financial decisions. Now let's talk about how banks conjure up these loans and credit limits seemingly out of thin air. It all boils down to a system called fractional reserve banking, a concept as baffling as it is ingenious. Imagine a world where banks could lend out money they don't actually possess. Sounds like financial sorcery, doesn't it? Well, in the realm of modern banking, that's precisely how things work. When you deposit money into your savings account, you're essentially entrusting the bank with your financial well-being. Banks don't keep all your deposits in their vaults. They use a fractional reserve system, holding only a small percentage set by the Bank of England, typically around 10% as a safety net. The rest is lent out to borrowers. When you deposit £100, the bank lends out £90. The borrower spends it, and it gets deposited again. This cycle repeats, creating new money. This is the money multiplier effect. It multiplies your initial deposit's impact. But this power has consequences for everyone. Let's talk about that seemingly innocuous savings account, marketed as a safe haven for your cash. Banks promise security and growth, urging you to deposit your money. But your savings account is not the gold mine you think it is. It's more like a financial mirage, barely keeping pace with inflation. On the flip side, we have the enigmatic world of credit cards, those ubiquitous pieces of plastic that have become synonymous with both convenience and financial peril. Banks love credit cards, and for good reason. They're a veritable gold mine, a seemingly inexhaustible source of profit that relies on a potent cocktail of consumer psychology, clever marketing, and, let's face it, our own spending habits. Here's where the disparity between savings accounts and credit cards becomes glaringly apparent. While your savings account languishes, earning a paltry 2% interest or even less, your credit card balance can accrue interest at an alarming rate, often exceeding 20% APR. That's a tenfold difference, a financial chasm that can quickly swallow even the most diligent saver. This stark contrast in interest rates is no accident. It's a deliberate strategy employed by banks to maximize their profits. It's as if they've set up a financial casino with your hard-earned money as the chips on the table. They're the house, and the house always wins. They entice you with the promise of easy credit, knowing full well that many will succumb to the temptation to overspend. And when those inevitable credit card bills arrive, they're there to collect, their coffers overflowing with the proceeds of your financial indiscretions. They've mastered the art of profiting from both ends of the financial spectrum, offering meager returns on savings while simultaneously charging exorbitant interest rates on debt. Now let's delve into the more insidious side of this financial ecosystem, the deliberate tactics banks employ to encourage us, the unsuspecting public, into a life entangled with debt. Imagine a world where debt isn't a last resort, but a lifestyle choice, carefully curated and presented as not only normal but even desirable. This, my friends, is the reality we inhabit, a reality meticulously crafted by financial institutions who profit handsomely from our indebtedness. It begins subtly, with seemingly harmless marketing campaigns that normalize the concept of debt. Credit cards, those shiny plastic rectangles, are often the gateway drug to debt. Banks dangle them before us, promising rewards and perks. Air miles, cashback, VIP access, all designed to entice spending. But beneath the glamour lies a cold truth, a cycle of debt. Miss a payment and those perks vanish, replaced by fees and high interest. Credit cards may be the most obvious culprit, but they're not alone. Banks normalize debt across the financial spectrum. Mortgages are now seen as essential, a way to get on the property ladder even if it means decades of debt. Student loans, once for accessibility, are now a crushing burden with ballooning interest rates. Debt normalization is insidious. The good news is that we're not powerless in this financial chess match. By understanding the rules of the game, we can make informed decisions, resist instant gratification, prioritize saving, and view debt cautiously. Knowledge is power. With it, we break free from debt, navigate confidently, and build a future where money works for us. In the grand theater of finance, it's crucial to identify the key players, those who reap the lion's share of the rewards while others struggle to make ends meet. Banks, with their ability to create credit and leverage debt, sit at the very apex of this power structure. But the consequences of this financial engineering extend far beyond the realm of personal budgets and credit card statements. When a significant portion of the population is burdened by debt, it creates a ripple effect that can destabilize entire economies. Consumer spending, the lifeblood of many nations, dwindles as individuals struggle to make ends meet, their income swallowed by debt repayments. This, in turn, can lead to a vicious cycle of economic stagnation. The housing market, fueled by easy credit and inflated prices, becomes increasingly vulnerable to bubbles and crashes, leaving homeowners underwater and the financial system teetering on the brink. The most tragic aspect of this system is the human cost it exacts. Beyond balance sheets lie stories of families struggling with debt, stress, anxiety, despair, hidden costs of a profit-driven system. Families forced to choose between food and credit card payments. These are the human faces of a system that treats individuals as mere cogs. It's time to challenge the status quo and demand a financial system that works for everyone. Reject the narrative that debt is inevitable. We have the power to demand transparency and hold banks accountable. It starts with education and continues with action, making conscious choices and exploring alternative financial models. It culminates in a collective demand for change, refusing a system that perpetuates inequality. We've journeyed deep into the labyrinth of the banking system, exposing its inner workings. Armed with this newfound knowledge, we can emerge from the shadows of financial ignorance and step into the light of empowerment. No longer mere pawns in their game, we can become active players rewriting the rules to serve our best interests. So, where do we go from here? How do we translate this newfound awareness into tangible action? The answer lies in financial literacy, mindful spending, and exploring alternative financial models. Imagine a financial system where bank account holders are not legally robbed. This is the system everyone yearns for, a system where banks serve the people. Educate yourself. Read books, articles, and blogs on personal finance. Engage with financial advisors who prioritize your well-being. Understand the financial landscape to navigate its complexities. Examine your spending habits. Are you living within your means or relying on credit? Track your expenses and create a budget. Taking control of your finances begins with taking control of your spending. Explore alternative financial models. Credit unions and ethical banks prioritize social impact and financial inclusion. Support these institutions for a more equitable financial future. Thanks for watching. Remember, your financial freedom starts with understanding the system. See you in the next video. If you find this informative, please subscribe to our channel, like and share.